In February 1995, a 28-year-old trader sat in a hotel room in Kuala Lumpur and sent his employers a fax that ended with an apology. Within days, the bank he worked for, the oldest merchant bank in Britain, 232 years in business, was sold for £1. The haul he left behind was £827 million. That was roughly twice the capital of the entire bank. And it had been dug in secret over nearly 3 years through a single hidden account numbered 88, an account almost nobody at Barings knew existed until the week the bank died. This is the story of Nick Leeson and the collapse of Barings, the plasterer's son who became the star of the Singapore trading floor, the error account that swallowed a bank, and the earthquake that finished what deception had started. And the flaw, one line in an organization chart that made the catastrophe not just possible but, in hindsight, very close to inevitable. Because Barings did not die because one man gambled. Banks survive gamblers every week of the year. Barings died because, for 2.5 years, one man was allowed to mark his own homework. To feel the weight of what fell in 1995, you have to understand what Barings was, because it was never just a bank. It was a piece of British history that happened to pay dividends. The house was founded in 1762, when George III had been on the throne for 2 years, by the sons of a wool merchant from Exeter. From cloth, the Barings moved into trade, from trade into financing other people's trade, and from there into the business that made them immortal, lending to governments. By the turn of the 19th century, when a state needed money, it did not go to a country. It went to a family firm in the City of London. The scale of what they became is genuinely hard to overstate. In 1803, when the young United States wanted to buy the Louisiana Territory from Napoleon, more than 800,000 square miles, doubling the size of the Republic at a stroke, it was Barings that stood behind the financing. $15 million moved across an ocean at the speed of sailing ships. And savor the detail. Britain and France were sliding into war, and the deal put cash into Napoleon's treasury. A British bank helping to fund the enemy, and such was the firm's standing that its reputation survived the contradiction intact. Money, Barings had understood before almost anyone, was an empire of its own. After Waterloo, it was Barings that raised the great loans allowing defeated France to pay its war reparations and rejoin Europe. A service so vast that the Duc de Richelieu, France's chief minister, is said to have remarked that there were 6 great powers in Europe: England, France, Prussia, Austria, Russia, and Baring brothers. The line is attributed rather than documented, and it is almost too perfect. Treat it as the legend Barings inspired rather than the minutes of a meeting. But legends of that size only ever attach themselves to real power. For the better part of 2 centuries, the power compounded. The family collected 5 separate peerages. The bank financed railways across Argentina, canals, empires, wars. When the brewer Guinness came to the stock market in 1886, it was Barings that brought the shares to a public so eager, the offer was swamped many times over. A Barings name on a prospectus was the city's closest thing to a guarantee. And it was reputed. Barings itself, of course, said nothing, because discretion was the product, to number the monarchy among its clients. The Queen's Bank, people whispered. Old money did not come older. And once, exactly once, it nearly died. In 1890, Barings gorged itself on Argentine bonds, and when Argentina slid into default and revolution, the unsaleable paper left the firm unable to meet its obligations. In November of that year, the governor of the Bank of England summoned the city to a secret weekend rescue, assembling a guarantee fund of some £17 million to stand behind Barings' debts. It worked. The firm was reconstructed. The family fortune took a generational blow, and the operation entered folklore as the first great lifeboat, the template for every central bank rescue since. But hold on to the shape of it, a Barings brought down by a bet on a faraway market, and a weekend of closed doors at the Bank of England to decide whether it lived. 105 years later, the same scene would be staged in the same building, with the opposite ending. Why the opposite ending? Because in 1890 the losses could be counted. Remember that, because the whole of 1995 turns on it. In 1890, Barings held bad bonds, but bonds have a flaw, and everyone around the table could see the bottom of the hole. In 1995, nobody could say what the losses were, because the positions were still open, the market was still moving, and the hole was still getting deeper by the hour. And the man who had dug it was on a plane. He was born in Watford in February 1967, on a council estate, the son of a plasterer. Nick Leeson left school at 18, having, by his own cheerful admission, a detail he told against himself for years, failed his mathematics A-level. His first job in 1985 was as a clerk at Coutts, by a neat irony, the other London bank reputed to serve the royal family. From there he moved to Morgan Stanley into settlements, the back office. Pause on that phrase, because the entire story lives inside it. The front office is the glamour, the traders, the shouting, the bonuses. The back office is the machinery behind them, the clerks who confirm each trade, record it, reconcile it, and move the money. The front office takes risks, the back office counts them. Keeping those two jobs in separate hands is not bureaucracy. It is the whole of the defense, the banking equivalent of the rule that the person who handles the cash is never the person who counts the till. Remember the distinction. It is about to become the most expensive line in the history of organization charts. Leeson joined Barings in 1989, and he was good, genuinely good, at the unglamorous work. Sent to Jakarta, he helped untangle a back-office nightmare, a backlog of unsettled share certificates worth some £100 million. He came home with a reputation as the man who cleans up messes, and with a fiancée, Lisa, a Barings colleague he met on the assignment. In 1992, aged 25, he was sent to Singapore to run the bank's small new futures operation on SIMEX, the Singapore Exchange. And here is the decision that killed Barings, made without ceremony, probably without much thought, as a cost saving in a distant outpost. Leeson was put in charge of the trading floor and the back office. He executed the trades, and then he settled, recorded, and reported the same trades. He kept score for his own game. It saved money for a while. There had already been a warning if anyone had wanted one. In London, an application to register Leeson had run into trouble when the regulator noticed an unpaid debt, a county court judgment, that his paperwork had not disclosed. The application was quietly dropped. The application in Singapore made no mention of any of it, and he was licensed to trade. The system's first missed catch, filed and forgotten. His job in Singapore was supposed to be boring. Barings believed its Singapore desk did arbitrage, switching, exploiting tiny price differences between Nikkei futures traded in Osaka and the same contracts traded in Singapore. Buy in the cheap city, sell in the dear one, pocket the sliver, take no view on the market. Done as designed, it is close to riskless. To the very end, London believed that was the business. Then, in the summer of 1992, weeks after trading began, an account was created in the Singapore system with the number 888888, 8 being the luckiest of numbers in Chinese business culture. Error accounts are normal in broking. Honest mistakes get parked in them, tidied up and closed out. By Leeson's own account, the first serious entry was a junior colleague's error. A young trader sold contracts a client had wanted to buy, a whole of around £20,000. And rather than report it, he buried it. That is his story told in his memoir, and you may weigh it accordingly. The account of a convicted fraudster explaining his first step is not a neutral document. What is not in dispute is what the account became. Because 8888 seat had a property that made it lethal, Leeson arranged the system so that it was stripped out of the reports sent to London. The exchange could see it. Cymex margined it daily like any other account, but Barings' own head office could not. From that moment, Nick Leeson was running 2 sets of books. In the visible set, a brilliant young trader printing steady arbitrage profits. In the invisible one, the truth. And because he ran the back office, he was the reconciliation. The books balanced because the man in the middle balanced them. There was a further layer of fog, and the official inquiry dwelt on it. Nobody in London quite owned him. Barings had recently bolted a securities business onto a centuries-old merchant bank, and Leeson sat inside a matrix of overlapping reporting lines, each side assuming the other was watching. The inquiry found that when the collapse came, senior figures could not even agree on who Leeson had actually answered to. A man who reports to everyone reports to no one, and this particular man was also the person writing the reports. The hidden numbers tell the story with terrible simplicity. By the end of 1992, account 888888 concealed losses of around £2 million. By the end of 1993, 23 million. By the end of 1994, £208 million. And over the same period, the visible Leeson had become a star. His desk reported profits of some £28 million for 1994 alone, making it one of the most profitable corners of the entire bank. London responded the way institutions respond to good news from a golden boy. It proposed a bonus of £450,000. And here, the bank's own voice enters the record in a sentence preserved in the official report. In 1993, the chairman, Peter Baring, told a senior Bank of England official that, in his experience, it was not actually terribly difficult to make money in the securities business. Savor that sentence. A supposedly riskless desk in a small overseas office was producing outsized profits, and the response at the top of a 230-year-old institution was not that cannot be right. It was satisfaction. Extraordinary profits from a riskless strategy are a contradiction in terms. The numbers themselves were the alarm, and nobody wanted to hear it because the alarm was ringing in the shape of money. By Leeson's own telling, there was a moment in 1993 when the hidden account clawed its way back to nearly flat, when he could have closed it, confessed, and walked away. His account, again, believe as much of it as you like. What happened instead is documented. The losses grew, and hiding them created a machine that demanded feeding. Losing positions require margin, daily cash, and to raise cash, Leeson began selling options, straddles, tens of thousands of contracts, collecting premiums for promising, in effect, that the Nicky would stay calm and stay put. Selling a straddle is selling insurance against the market moving in either direction. In a quiet market, the premiums roll in. In a violent one, the seller is ruined. He had bet the bank, by now quite literally, on Tokyo staying still. And people did ask questions. That is the terrible part. This is not a story of an alarm that never sounded. In the summer of 1994, Barings' own internal auditors examined Singapore and warned in writing that one man controlled both the front and the back office, that he could override the controls, and that the roles should be split. The recommendation was noted. It was not implemented. In January 1995, the Singapore Exchange itself wrote to Barings, querying whether the bank could fund the margin on a large account 888. Letters about an account head office did not know it had, and the responses were prepared in the office of the man they were about. Around the same time, the year-end audit turned up a hole, and Leeson covered it by inventing a receivable £50 million, supposedly owed by a New York broking firm. He forged the confirming documents with scissors, glue, and a fax machine, and investigators later found that one forgery carried at the top of the page the printed header of the machine that had actually sent it, his own fax at home. The paperwork was accepted. So stand at the end of January 1995 and count the position. Hidden losses past £200 million. Tens of thousands of short straddles sold to pay for the hiding. A bank in London wiring money to Singapore on request and believing its own press. Everything now depended on one thing only: the Nicky staying inside its calm, narrow band, not rising much, not falling much. The whole edifice, the account, the career, the bank, 2 centuries of name, balanced on the market doing nothing. At 5:46 on the morning of the 17th of January 1995, 20 kilometers beneath the Japanese port city of Kobe, the ground began to move. The Great Hanshin earthquake lasted around 20 seconds and measured magnitude 6.9. It killed more than 6,000 people, injured tens of thousands, and leveled whole districts of one of Japan's great industrial cities, the country's worst earthquake since 1923. It was, first and before anything else, a human catastrophe. And 600 kilometers away, on a trading floor in Singapore, it was also something else: the end of the calm that one trader had secretly sold. For a few days, the market absorbed the shock. Then, on the 23rd of January, the Nikkei fell more than 1,000 points in a single session, and Leeson's short straddles began to hemorrhage. A trader risking his own book takes the loss and lives. But Leeson was not managing an investment. He was concealing a crime, and a concealed loss has a logic of its own. It can only ever be redeemed by a win. So he did the thing that turns bad losses into historic ones. He doubled. Understand the arithmetic he was now trapped inside. His straddles paid off only if the index stayed near the level where he had sold them, roughly the level Tokyo had traded at before the ground moved. Every point the Nikkei fell below that band cost him twice, once on the options, once on the futures he was buying to fight the fall. So the position had a single number at its heart, a line on a chart at which Nick Leeson got his life back, and through February 1995, the market sat stubbornly below it. Through late January and February, Leeson bought Nikkei futures on a scale exchanges rarely see, in effect, an attempt to hold up the Japanese stock market single-handed. By the end, the official investigation found positions equivalent to roughly $7 billion American dollars riding on Japanese shares. Alongside short positions of the order of $20 billion against Japanese government bonds and interest rates, bets that also promptly went the wrong way. At one point, his buying reportedly accounted for the majority of the entire open interest in the main Nikkei futures contract. One man, in one office, had secretly become the largest single force in Japan's futures market. And the margin bills for all of it were being paid, day after day, by London. That is the detail that should stop you cold. Barings' head office was wiring money to Singapore, funds it believed supported client business and riskless arbitrage, and by the final week it had sent, cumulatively, more than £700 million. More than the entire capital of the bank, transferred to one outpost without anyone ever forcing a reconciliation of whose money it was or what exactly it was margining. The requests were explained away as a timing mismatch, and the money went out under a label, loans to clients, that nobody tested against a list of actual clients. There was no such list. There were no such clients. There was only 888888. Hold that thought. A bank quietly wiring out more than its own net worth to an office nobody was independently checking, because the machine now had days to live. The end came in the last week of February, and it came quickly. An accountant sent from London was in Singapore, trying to reconcile a gap of hundreds of millions of pounds that refused to explain itself. The exchange's questions were sharpening. The Nikkei kept falling, and the bank's bonus day was only days away. On the afternoon of Thursday, the 23rd of February 1995, Nick Leeson and his wife left Singapore and surfaced across the border in Malaysia. On his desk, it is widely reported, he left a scribbled note. It read, "I'm sorry." That night, and into the next day, Barings finally opened the box it had owned for 3 years and found account 888888. Executives sat in London doing arithmetic that got worse with every recount, while from the Regent Hotel in Kuala Lumpur came the facts, the resignation of the man who was already the most wanted trader on earth, offering, in words that have followed him ever since, his sincere apologies for the predicament that I have left you in. The predicament was £827 million, and it was still growing because Tokyo would open again on Monday. What followed was the 1890 rescue replayed as tragedy. Through the weekend of the 25th and 26th of February, The governor of the Bank of England, recalled from a skiing holiday, convened the city's bankers in Threadneedle Street, exactly as his Victorian predecessor had done 105 years before, to ask the same question: does Barings live? The bankers were willing up to a point. A fund to absorb the known losses was actually taking shape around the table. What no one would do was sign for the unknown, because Leeson's positions were still open. Tokyo would open on Monday, and no banker alive writes a check for a loss with no ceiling. The rescuers spent Sunday hunting for someone rich enough to cap the risk, and for a few hours a name circulated that seemed made for the story. Reports at the time said an approach involving the Sultan of Brunei was explored and came to nothing. That was the difference a century made. In 1890, the hole had a bottom. In 1995, it did not. The Bank of England judged the failure containable and declined to reach for public money. Late on Sunday, the 26th of February 1995, Barings, banker to empires, the sixth great power of legend, 232 years old, went into administration. It was dead by bedtime. On Monday, the Nikkei fell again, deepening the hole out of sheer momentum. The Chancellor stood up in the Commons. 1,000 employees' bonuses evaporated with the bank that owed them. And within days, the whole house, name, offices, business, history, was bought by the Dutch group ING, which assumed the liabilities and injected some £660 million to stand the business back up. The purchase price for Barings itself was £1. Leeson, meanwhile, was running out of map. He and Lisa flew via Brunei towards Europe, hoping to reach Britain and face trial there. German police arrested him when the plane touched down in Frankfurt on the 2nd of March. He spent months in a German cell fighting extradition while it became clear the British authorities would not be bringing him home. In November 1995, he agreed to return to Singapore, and in December he pleaded guilty to 2 charges of deception: deceiving the bank's auditors and cheating the exchange. He was sentenced to 6.5 years, and the era's defining financial criminal disappeared into a Singapore prison at the age of 28. The endings, as ever, deserve their ledger. Leeson served his time in Singapore. His marriage did not survive it, and neither, very nearly, did he. Diagnosed in prison with colon cancer, he was treated, recovered, and was released in July 1999. His memoir, Rogue Trader, written while he was inside, gave the phenomenon its household name and became a film. And his afterlife is its own commentary on the modern economy. He re-emerged as a conference speaker and risk consultant, and today is paid by the very industry he humiliated to explain how he did it, the poacher hired to lecture the gamekeepers. Peter Barings' family lost the bank that carried their name. The official inquiry that followed laid the fraud squarely at Leeson's door, unauthorized, concealed, and his, but laid the collapse at the door of Barings' management, whose controls it found had failed at every level that mattered. Singapore's own inspectors were harsher still about how much London should have seen. Several senior figures left the industry under regulatory censure, but no one else went to prison. Of all the people who touched the money, only the man in account 888 ever saw the inside of a cell. So, what did the death of Barings actually teach? First, the one-sentence cause. now taught in every bank on earth. Never let the person who takes the risk be the person who counts it. Leeson settled his own trades. That is the entire mechanism, and everything else is detail. The separation of front and back office went overnight from good practice to sacred law, and every irritating control in modern finance, the second signature, the independent confirmation, the compliance officer reading your trades, is a small monument to Singapore. Second, the machinery repeats, because the temptation repeats. In 2008, a trader at a great French bank was found to have hidden positions that cost it the equivalent of £4 billion. In 2011, a trader in London lost an American bank more than $2 billion the same essential way. Both were convicted. Both had learned, as Leeson had, that the gap between the trade and the record of the trade is where a bank's whole capital can quietly drain away. Each time, the ghost of 88888 walked. Third, and this is Barings' truest legacy, the collapse changed what banks are required to fear. Before 1995, banking regulation measured market risk and credit risk, the risk of prices, the risk of borrowers. Barings proved that a clerk with a fax machine could outkill both, that the deadliest exposure could be the bank's own plumbing. Regulators gave that danger a name, operational risk, and when the world's capital rules were rewritten, banks were for the first time made to hold capital against their own internal failures. The case file behind the idea, to a remarkable degree, was a single office in Singapore. And beneath all of it sits the human lesson, the one no rule book fully fixes. Nobody audits good news. Barings had the warnings, the auditor's report, the exchange's letters, the arithmetic of a riskless desk producing impossible profits. What it did not have was the will to disbelieve money. Too good to be true is a control, and at Barings it was switched off at the top. Set this story, finally, beside the one this channel began with. In September 1992, one man broke the Bank of England, an outsider, attacking from without, in the open, betting billions against a doomed exchange rate. The bank was humiliated and survived. In February 1995, the attack came from within, a trusted insider in secret wearing a staff pass, and the institution did not survive. That is the pairing to keep. Institutions are built to face outward, walls against the barbarians. Barings' walls were never breached. The thing that killed it was already inside, running the back office, marking its own homework, which is why, ever since, the checking of the checkers has been the quiet heart of banking. The money in your account is guarded less by vaults than by reconciliation. And the first time Barings died, the Argentine gamble of 1890, the secret weekend at the Bank of England, the lifeboat that worked and invented the modern bailout, that story is where we go next.